March 27, 1980, Silver Thursday. The Hunt brothers' silver empire collapsed in a single day, triggering panic that nearly destroyed the global financial system. The silver price plummeted from $50 to $11 in hours. Margin calls totaling $1.7 billion went unmet. Emergency Federal Reserve intervention was required to prevent systemic collapse. The financial world had never seen anything like it. Fast forward 46 years to today, January 30th, 2026. Silver crashes 31% in a single trading session, the worst decline since that infamous Silver Thursday. Bloomberg's head of metals strategy, Nikki Shields, writes 3 words that will define this era, quote, parabolic, frenzied, untradeable, end quote. She declares January 2026 the most volatile month in precious metals history. The question everyone is asking, are we witnessing Hunt Brothers 2.0, or is something far more dangerous unfolding right now? The Hunt brothers, Nelson Bunker and William Herbert, were Texas oil billionaires, sons of H.L. Hunt, the richest man in the world, in 1960. In 1973, after Libya's Gaddafi nationalized their oil fields, the Hunts became convinced the U.S. dollar was doomed. Between 1973 and 1979, they accumulated over 100 million ounces of physical silver. They partnered with Saudi investors to form the International Metal Investment Group, acquiring another 150 million ounces. At their peak, they controlled nearly half of the world's available silver supply. Silver price? $6 in January 1979. By January 1980, $49.45, a 713% increase in 12 months. On January 7, 1980, COMEX changed the rules. They implemented Silver Rule 7, heavy restrictions on margin purchases. The Hunt brothers could no longer leverage borrowed money. The price fell 50% in 4 days. March 25, 1980, Bunker Hunt missed a $100 million margin call. 2 days later, Silver Thursday, the price crashed to $10.80. The Hunts faced a $1.7 billion loss. The Federal Reserve orchestrated an emergency bailout. Banks nearly collapsed. The Hunts were convicted of market manipulation in 1988, fined, and banned from commodity trading for life. The lesson? 3 brothers tried to corner silver and destroyed themselves through leverage and greed. But was that the whole story? Here's what they forget. In 1979-1980, it wasn't just silver that went parabolic. Gold hit $850, platinum, palladium, oil, copper, all hit record highs. Did the Hunts corner everything? Jeffrey Christian, a metals expert who worked during that era, estimates the Hunts added maybe 50 to 75 cents to silver's price. Not $50, 75 cents. What really drove silver? Massive inflation, dollar debasement fears, and genuine demand during a currency crisis. The U.S. nearly lost control of the dollar in January 1980. Paul Volcker raised rates to 20% to save it. The Hunts became the perfect scapegoat. They were riding a currency crisis wave until regulators changed the rules to crush them and restore order. December 2025. Silver trades at $35. The metal has been in structural supply deficit for 7 years. Industrial demand consumes 60% of supply. Solar, EVs, AI data centers. Early January 2026. Silver crosses $60, $70, $80. Unlike 1980, this wasn't Texas billionaires. This was Chinese retail speculators, millions of investors fleeing their collapsed stock and property markets. Social media in China exploded with silver groups. Shanghai futures saw record volumes. Physical premiums soared $8 above COMEX. Unprecedented scarcity. January 23rd. Silver hits $121. Gold passes $5,500. Then the triggers. Trump says the dollar is doing great. Markets sense intervention coming. But the real catalyst? Bloomberg reports Trump will nominate Kevin Warsh as Fed chairman, the most hawkish hard money advocate in finance. Chinese investors who'd been buying suddenly sell massively. January 30th, silver gaps down. $8, $12, $20. Margin calls hit. Forced liquidation begins. In 20 hours, silver plummets from $121 to $71, a 41% collapse. Surface similarities are obvious, but fundamental differences reveal why 2026 is more significant. Difference 1. Market structure. In 1980, the Hunts controlled silver through concentrated positions. COMEX changed margin rules and crushed them. In 2026, leverage is distributed across millions globally. CME can't target specific bad actors. Difference 2. Structural deficit. 1980 had no fundamental shortage. 2026 has 7 consecutive years of deficits totaling 820 million ounces. Solar panels consumed 17% of global supply in 2025. EVs, AI data centers, demand is accelerating, and 75% of silver is a byproduct of copper, zinc mining. Supply is structurally inelastic. Difference 3. Inventory collapse. COMEX registered inventories collapsed 70% since 2020, from from 346 million to 113 million ounces. But open interest represents 1.586 billion ounces. 14 paper claims per physical ounce. December 2025, 60% of inventory, 47.6 million ounces, claimed in 4 days. Created backwardation, never happened in 1980. Difference 4. The China factor. January 1, 2026. China implemented export restrictions. Only state-approved companies with 80-ton capacity can export with special licenses. China reclassified silver as strategic. They're hoarding for domestic use while cutting global exports, creating a two-price world. Shanghai trades $20 above COMEX. Difference 5. The paper-physical divorce. For decades, trust existed that paper claims convertible to physical. That trust is breaking. January 30th. COMEX crashed to 71, Shanghai physical still above 100. Dealer coins, bars, 90 to 110 with weeks delays. Paper crashed, physical ignored it. The shortage is real. So let's get tactical. How did this crash actually unfold mechanically? Because understanding the machinery reveals why this might not be over. First, you need to understand margin requirements. When you buy a futures contract, you don't pay the full value up front. You put up a percentage as collateral. That's your margin. Historically, silver futures required about 10 to 11% margin. As silver prices skyrocketed in January 2026, the CME Group, the exchange operator, got nervous. If prices kept rising and someone defaulted, the clearinghouse could face catastrophic losses. So they implemented a new percentage-based margin system. Maintenance margin requirements jumped to 15% for standard positions. For heightened risk accounts, 16.5%. Now here's the trap. Imagine you bought a silver contract at $90 with 11% margin. You put up roughly $10,000 to control a $50,000 position. Silver rallies to 120. You're sitting pretty with massive paper profits. Then the margin requirement increases to 15%. Suddenly you need to post $18,000 instead of $10,000. That's an extra $8,000 in cash you must deposit immediately. Can't make the margin call? Your position gets liquidated, sold at whatever the market price is. This is exactly what happened to the Hunt brothers in 1980 when Silver Rule 7 was implemented, and it's exactly what happened to thousands of speculators on January 30th, 2026. But here's the truly insidious part. The Shanghai Futures Exchange simultaneously implemented its own restrictions. They expanded daily price limits, raised margin requirements to 11% for speculative positions, reduced daily opening position limits for silver futures to 800 lots, and barred 16 clients from opening new positions for 1 month due to disclosure failures. So you had coordinated margin increases hitting from both the New York COMEX and the Shanghai Exchange at the same time. Chinese speculators, who had been the primary buying force, were suddenly forced to sell. When both legs of the global market face liquidation pressure simultaneously, you get what we witnessed, a cascading avalanche. Prices fall, margin calls hit, forced selling accelerates price decline, more margin calls hit, more forced selling, the death spiral. By the time silver hit $71, an estimated 725 million ounces of short positions were underwater across COMEX and LBMA markets. These are traders who had sold silver, hoping to buy it back cheaper. As prices had rocketed to 120, these shorts were facing annihilation. The crash saved them. When prices collapsed, shorts could cover their positions at $70 to $80 instead of 120 plus. They made fortunes. Who lost? The leveraged longs who bought high and were forced to sell low. Now here's the conspiracy theory that actually has merit. Some analysts are pointing out that the timing of the Kevin Warsh nomination leak was convenient. The leak came from Bloomberg, a terminal that every major financial institution watches. It hit right as Asian markets were still open, triggering the Chinese selling wave. And it came just days after CME margin requirements had been raised, maximizing liquidation pressure. Coordinated or coincidence? What we do know, major banks and institutions who were short silver made billions on January 30th. Retail speculators and Chinese investors got obliterated. And the officials who changed the margin rules, they claimed they were protecting market stability. Sound familiar? It should, because that's the exact same justification they used in 1980 for Silver Rule 7. The difference this time? The fundamental physical shortage doesn't care about margin requirements. You can change the rules on paper contracts all you want, but you can't create silver out of thin air. So here we are, February 4th, 2026. Silver has recovered from the $71 lows to $90 and change. It's consolidating in what technical analysts call a relief rally after extreme capitulation. The big question, is this rally sustainable? Or are we setting up for Hunt Brothers 2.0, round 2? Let's look at the evidence for both scenarios. The bull case, why this could explode higher. Point 1. The physical shortage is real and worsening. Annual silver supply deficits continue. The Silver Institute projects another 150 million ounce deficit in 2026. That's equivalent to the entire annual output of Peru, the second largest silver producer. Mine supply cannot increase quickly. New silver mines take 8 to 12 years to develop from discovery to production. And remember, most silver comes as a byproduct of copper and zinc mining. Unless copper and zinc prices justify increased mining, silver supply stays constrained regardless of silver prices. Point 2. Industrial demand is accelerating, not declining. The International Energy Agency projects that solar panel installation will double between 2025 and 2030. Each gigawatt of solar capacity requires approximately 30 metric tons of silver. Electric vehicle production is still growing globally, despite subsidy cuts. And AI data centers, which require silver for high-performance electronics, are being built at a breakneck pace. Point 3. China's export restrictions are permanent. This isn't a temporary policy. China has designated silver as a critical strategic material. They're going to hoard domestic supply for their own industrial needs. The rest of the world must compete for increasingly scarce non-Chinese supply. Point 4. COMEX inventories continue draining. In the weeks since the crash, registered inventory has continued falling, not recovering. Physical metal is leaving vaults. London is seeing outflows. The backwardation in futures markets, where spot trades above futures, has returned after briefly normalizing. Point 5. Central banks are starting to buy silver. While gold has always been a central bank reserve asset, silver was ignored. That's changing. Russia confirmed in 2025 that it would add silver to central bank allocations. The United States officially designated silver as a critical mineral in 2025, adding national security dimensions. If even a small percentage of central bank gold buying shifts to silver, given silver's much smaller market size, the price impact would be massive. The bear case. Why this could crash again. Point 1. Leverage is still excessive. Despite the January 30th liquidation, open interest in silver futures remains elevated. Speculative positioning hasn't fully washed out. This means another margin call event could trigger another crash. Point 2. The strong dollar kills commodities. Kevin Warsh as Fed chair means potentially higher interest rates and a stronger dollar. Historically, when the dollar rises, commodities fall. Silver is priced in dollars globally, so dollar strength creates mechanical selling pressure. Point 3. Recession fears could crater industrial demand. If the global economy slides into recession in 2026, solar panel installations could slow, EV production could decline, electronics demand could weaken. This would reduce the industrial bid for silver. Point 4. Price-driven substitution is real. At $120 per ounce, manufacturers were desperately searching for alternatives to silver. Some high-end electronics can use palladium or platinum. Some solar panels can reduce silver loading. If prices stay elevated, substitution accelerates, reducing long-term demand. Point 5. Regulators could intervene more aggressively. In 1980, they didn't just change margin rules. They eventually forced Hunt Brothers liquidation through legal and regulatory pressure. In 2026, if silver threatens financial system stability again, don't think they won't step in harder. So which scenario plays out? Here's my analysis based on the data. The short term, next 3 to 6 months, remains highly volatile. We're likely to see silver swing between $75 and $110 as leveraged specs get washed out completely. Every rally will attract momentum traders. Every dip will trigger buy the dip retail demand, rinse and repeat. The medium term, 6 to 18 months, the fundamental supply-demand imbalance reasserts itself. Once the speculative froth is completely removed, the real shortage becomes undeniable. That's when you could see the price grind higher to new highs above 120, but in a more measured, less parabolic manner. The long term, beyond 2027, depends entirely on whether new mine supply comes online and whether substitution reduces demand. If neither happens fast enough, silver could genuinely trade at $150 to $200 as a structural supercycle plays out over years. But there's a wild card that nobody's talking about. The real danger isn't just price volatility. It's what happens when the paper-physical disconnect becomes undeniable and permanent. Right now, the entire global financial system assumes that COMEX silver futures prices represent the real price of silver. Billions of dollars in industrial contracts, mining agreements, hedging programs, and financial derivatives are based on COMEX pricing. But what happens when industrial users in the United States or Europe can't get physical silver at COMEX prices anymore? What happens when a major solar manufacturer places an order for 10 million ounces at $85 per ounce COMEX, but their supplier says, sorry, physical is 115, and we have 12-week delivery delays? This is what's called a broken price discovery mechanism. The futures market says one price, the physical market says another, and the gap keeps widening. In the lithium market, this already happened. Paper lithium contracts became meaningless because the physical market diverged so dramatically. Buyers stopped trusting futures prices and went straight to physical suppliers. If this happens in silver, the COMEX could lose its price-setting role entirely. And that's when things get really dangerous, because the COMEX isn't just a speculative casino. It's the backbone of industrial hedging and commercial risk management. Major silver mining companies use COMEX futures to hedge their production. They sell future output at locked-in prices to ensure stable cash flow. But if COMEX prices don't reflect physical reality anymore, those hedges become disastrous. A mining company hedged at $90 COMEX. Physical trades at 130. They're locked into selling at 90 while their competitors sell at 130. They go bankrupt even though silver prices are high. This is the systemic fragility nobody is discussing. And then there's the clearinghouse risk. The CME clearinghouse guarantees every futures contract. But what happens if a major participant defaults because they can't deliver physical silver against contracts? In 1980, the Hunt brothers' default nearly collapsed multiple brokerages and banks. The Federal Reserve had to orchestrate a bailout. In 2026, the notional value of outstanding silver derivatives is vastly larger. The leverage is distributed across thousands of participants globally. If something breaks, if a major bank or trading house faces a silver delivery failure, the contagion could spread through the entire commodity complex and into the broader financial system. This is why I think January 2026 might be worse than 1980 in the long run. In 1980, they crushed the Hunt brothers and the problem went away. In 2026, you can't crush millions of Chinese retail investors, hundreds of industrial users, and multiple sovereign nations simultaneously. The genie is out of the bottle. The world has seen that paper silver and physical silver are not the same thing, and once that trust is broken, it can't easily be restored. So is this Hunt Brothers 2.0? Yes and no. The superficial parallels are obvious. Parabolic price rise, leverage-fueled speculation, regulatory intervention via margin hikes, catastrophic crash, widespread liquidation. The playbook seems identical. But the fundamental reality is completely different. The Hunt brothers were trying to corner a market that had adequate supply. 2026 is experiencing a genuine physical shortage in a dual-use commodity that's critical to the green energy transition and technological infrastructure of the future. The Hunt brothers were three billionaires who could be crushed by regulators. The 2026 squeeze involves millions of participants across multiple continents and includes sovereign nation export controls that can't be easily reversed. In 1980, when the dust settled, silver returned to normal because there was no structural deficit. In 2026, when the dust settles, the shortage will still be there, and it's getting worse, not better. Bloomberg called January 2026 the most volatile precious metals month in history. They're absolutely right. But volatility isn't the real story. The story is that we're watching the birth of a two-tier silver market, paper and physical, and nobody knows how this ends or what comes next. The Hunt brothers tried to corner silver and failed spectacularly. China might succeed without even trying, simply by keeping their domestic production for domestic industrial use. The price at $90 today? It's not the destination, it's just another waypoint in what might be the most important commodity story of the decade ahead. Welcome to Hunt Brothers 2.0. Except this time, there's no bailout that can fix the fundamentals. And that is why this is far more dangerous than 1980 ever was.